The market seems poised for another leg lower in the downtrend after Wednesday's tariff news and Friday's inflation data. In the midweek video, we talked about a bearish weekly close, and it's actually much worse than what we forecasted out there. So buckle up and welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame chart, talking about candle structure and location as we always do. And of course, Monday is the final trading day of March, so this is subject to change, and if anything, we might get either a little bit more of a lower wick or just no lower wick at all, depending on the Monday close. But for the most part, we can see we're dealing with a solid red-bodied bar, indicating that sellers are in control on the structural front. If we think about location on the bar-to-bar count, we certainly have a lower high as well as a lower low. And this is after an inverted hammer here took out the previous two highs and then closed back inside of what could be considered a multi-month balance range back here. So it's undoubtedly a bearish breakdown in the short term, but let's not forget about the idea that the monthly trend is still up, right? We have lows, we have soft higher lows here, firm higher lows here with the weekly downtrend, very mild weekly downtrend in here, so maybe soft-ish higher lows. It's very possible that pulling back from the highest high in the monthly trend count, we can still afford to find some sort of higher low. And if you've been tuning into the past couple of monthly analysis videos, you really know that we're looking at a retest of the breakout point here, which is much closer to 525. 525 is also, if we go ahead and throw on the monthly 20 SMA, let's just readjust our drawing here, it ties in beautifully from a technical point of view. So is it possible that there's a little bit further downside pain in the market? I think the answer is yes, and we'll see that on the shorter time frame charts as well. But when we start approaching 525 from the highest time frame monthly, I'd be particularly interested in seeing whether or not buyers step up towards that technical level. Now, there's one more tidbit that I'd like to throw in here, and this comes from Chris Schiavocco over at Schiavocco Capital, always giving credit where credit is due. He's done extensive research on the average and median drawdowns through secular bull market pullbacks. And what he's found is that typically the deepest of pullbacks before things tend to get much worse is about 14.5%. And notice, if I use our little measuring tool here, from the all-time high to 525, monthly 20 SMA, previous breakout level, 14.39%, right on the money. So I'm very interested if the monthly pulls back to that level, looking for buyers and seeing whether or not the monthly will produce that higher low. Of course, in the short term, to get there, it would imply further pain for the market. Let's quickly check in on some Fibonacci's here before we move to the weekly. Just want to make note that this would be a pullback over the Fib 38.2 from the 2022 drawdown low, which I do think is an important metric as well. It would classify this as a bull flag pullback from the monthly point of view, as long as the chart developed into something like this. So first test, really looking for that 525, supported by the Fibonacci's also. If we come in from the biggest bull flag we think we've ever seen, the sickness low, up to, if we could get a click, thank you, to the previous all-time high, to the pullback low of 2022. I would just remind folks one more time that the location of this pullback off of 611, look at that beautiful round number on Thinkorswim, it makes sense. It is a logical pullback from a measured move in one of the biggest patterns we've seen play out in a very long time. So is it reasonable, once again, that we could be seeking this monthly higher low, 525? I think the answer is yes. But you're not here for the monthly outlook, or I don't think you're here for the monthly outlook. Let's get a little bit more granular and drop it on down to the weekly perspective, and we'll keep on moving into our more granular looks. What do we see on the weekly structure and location? Certainly a solid red-bodied bar with a little bit of an upper wick. When we checked in on the Wednesday midweek market update, this was looking like a tiny little bearish inverted hammer, something along these lines right here. And one of the things we said was, oh, it's probably not great that we're back inside of the previous week's range, but it would be a little bit worse if we closed the weekly bar underneath the weekly 50 SMA. Lo and behold, this is a bearish engulfer on the weekly structure. You can see that we looked over the previous week's high. Buyers failed to produce price acceptance up there. There was no support in the previous week's range. And where did we close? Underneath the previous week's low. We are certainly underneath the do or die zone low. If we do something that looks like this, remember that we're using previous resistance, support, support, 50 SMA is in there. The close below is pretty darn concerning. And in my view, it would suggest at least an equal low test here on the weekly to the lower wick of the larger hammer candle. That was the one sort of maybe like a shimmer of hope, right? Oh, look, it's a hammer candle on the weekly near the 50. If it's going to cause a rebound over the hammer high, the market should be off to the races. If this is a V-shaped recovery, which we talked about, the odds of that being quite low because this was not a capitulation style move to the downside, right? We did not see that major volatility spike. We didn't see the panic, widespread fear. Oh my God, I can't believe the market gapped down 20 points. It was intraday activity that brought us into that low. So all things considered, this to me seems like a great opportunity for a retest of the low, and if we go through, that's where we start thinking about that 525 monthly pullback that we were just describing on the higher time frames. In the overall trend count here, we do have a firm weekly downtrend now with, of course, some semblance of highs. This is a lower high rejection. This is a low. This is a lower low. So the weekly trend is officially down. If we come in here with our Fibonacci's from the last major high or low to the all-time high, we have continued to reject the Fibonacci 38.2. That is a bearish indication. We're technically in no man's land, but if we come back down to the 61.8 and go through, that would mean that a 100% retracement would be more likely. I would still be very, very interested in the 525, which is technically ahead of the 100% retracement. If we clean that up and come in with a fib from the high to the low of the move, notice the rejection of the 38.2. What does that mean? That this is technically classified as all bear flag consolidation. Really not seeing anything all that compelling for the bulls on the weekly time frame. If we come in with the anchored VWAPs on the weekly, the all-time high anchored VWAP has been added and adjusted. It's a rejection perfectly there. The anchored VWAP from here is a perfect rejection as well in the upper wick of last week's bar. We're clearly underneath these, and the next one ties in where? Can't make this stuff up. It's beautiful, right around that 525 level that we're mostly interested in from the monthly perspective. So bears probably have the edge here from an anchored VWAP point of view. Let's quickly check in on the volume profile. Let's zoom out here. And let's just continue to point out, if we bring in this high volume node, it's another rejection of the high volume node. We can even take this one and note that we have closed underneath that secondary high volume node as well. Bulls probably wanted to use that as an area of support on any potential pullbacks and something that would have looked like this. Obviously not the case. We clearly also, this was more of a Wednesday topic, but have identified if this is a double top, this is a perfect retest rejection of the neckline on the weekly time frame. All of the traders in here who were long are now trapped overhead supply. If they haven't closed out already, they're feeling the pressure, they're feeling the pain. You know, I think it's been pretty clear about the bearish technicals here on the weekly. Let's drop it on down to the daily time frame chart. Let's get granular here and evaluate this week's expected move. It's off the screen to the downside. Let's adjust a little bit. And there we go. So the expected move is this box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 569.85, and that to me is very important because it would actually suggest another lower high here. That is indeed bearish for our trend count. If we're contained by the lower bound, the number is 541.45, give or take, and of course, that is a major lower low in the overall trend count as well. Expected move is undoubtedly bearish here. The next thing I'll point out about the expected move in particular is that it does not seem to fully reflect the increase in volatility that we saw on the Friday session. Look at Friday's range and look at the overall expected move for the week. In the span of 2 candles, we could basically exceed the expected move if we keep up the same degree of volatility, which I think is somewhat likely given that the market's kind of on edge here with the tariff news, as well as the stagflation fears, and just consumer sentiment is in the gutter right now, which we'll get to in the fundamental section of today's video. Point being is that I would not put a lot of emphasis in saying, okay, the upper edge or the lower edge of the weekly expected move needs to act as support or resistance, right? So let's get back to basics here. What's the overall daily trend? It's just remained in the downward direction. We have the all-time high, which is the highest high in the trend count. This was a soft lower high. We'll continue to go through this exercise because I think it's important, right? This was hardly an hourly uptrend. Here we finally got an hourly uptrend off the dead low, the lowest low in the move, and this is a weekly lower high. It's a daily lower high as well. This didn't count as a daily higher low because we did not have an hourly downtrend to produce that. It was just a gap down. So all things considered, the daily trend remains in the downward direction. We just talked about how this right here is a perfect retest rejection of the neckline of the weekly double top. It's a rejection of the daily 200 SMA, which is the green moving average on your screen, and price hardly found any acceptance over the top end of the do or die zone on that Monday and Tuesday session. There was one day of consolidation Wednesday with the auto tariff news straight back down into the do or die zone. Thursday, very weak, not finding any acceptance. Let's zoom in on this a little bit further as we're talking about it, actually. Not finding any acceptance near the midpoint of the Wednesday breakdown, not finding any acceptance over these previous wick highs. Remember, this is the FOMC wick high. This is the Thursday follow-up rejection. Friday was sort of detrimental on the gap down. Regardless, those highs, perfect rejections there on the Thursday intraday session. You could also argue it was a rejection of Monday's open and Monday's low. So do we have stronger buyers stepping up in the market? Hard to say that when there's not much acceptance over the 200, when this candle clearly closed the gap, or I should say Thursday really closed the gap. But how did Thursday's structure close? Did we have a strong response from the buyers? Not really. We closed unchanged from the open and once again rejecting the previous ranges from Monday, Tuesday, and a majority of that Wednesday session. So stronger buyers not here. That was the argument in the Wednesday video. We'll see that again on the market internals. We'll just recap that. And then, of course, Friday is just like sayonara. We break down back into the original range, which I would argue is from here. We failed to hold that Friday low. This was the key Friday low, which establishes the do or die zone low with the weekly 50 SMA and the weekly structure. And it's just a full rotation right back down towards the bottom end of the range. So as we walk forward into the upcoming week's worth of trade, yeah, of course I would be looking for any rallies that retrace some of this move. A lower high here. I know it's not the classic textbook location for one of these patterns, but smack on the floor of the move, there's a head and shoulders, right? The main premise being that we have a high, maybe some semblance of a higher high, a lower high, signals that shift in short-term trend from hourly uptrend to hourly downtrend. Now we just look for equal low breakdowns. That establishes the weekly equal low, if not further, and we're looking at a lower low to continue the trend. So of course the do or die zone low is going to become critical here at 565.50 for rejection lower highs. But honestly, if we take it on down to the hourly time frame chart, we can start to get even more granular here. And what I want to point out is, remember, one of the main reasons that we were somewhat open-minded to, okay, this is not exactly what the sellers should have been looking for. We'll maybe keep an open mind to a gap fill reversal long if it wants to establish something that looks like this. Remember, we had used these previous highs back over here at 570. Let's just round off to 570. That didn't happen. Now, why is this so important? Because this was really a balance range. We have highs, we have equal highs, we have lows, we have equal lows. The hourly trend was actually neutral here. This is what causes the hourly trend to flip back to up. So the fact that we're now underneath the original balance range that neutralized the hourly trend, right? That means to me that I would honestly, on the hourly perspective, be really interested in 559.75 lower high rejections. I could probably make that a firm, solid level, not a gray dotted level. But this to me, very interesting. Very, very interesting. All of this remains as overhead supply. It's clearly just a lower high in the hourly trend count, and it does not even involve a full retest lower high up against 565.50. Now, don't get me wrong, this is still an ideal place for the lower high to take place, but it would be even better. It would be, for the bears at least, for us to trade downside outcomes. It would be even more bearish if this lower high is set here at 559.75. So let's come in with the fibs from the low of this move up to the top of this move. And what we'll notice is this, as we talked about in Wednesday's video, it was the 38.2. It was the gap fill reversal back to the Friday high from back here. No dice, no love, straight through it on the Friday session, opening drive to the downside and consolidation into the lows. Did we find support at the 61.8, which would have been the bottom end of this balance range here? The answer is also no. So if you're a stronger buyer in this market, you go 2 for 2 on the Friday session. You do not hold up for a gap fill reversal high or low here to continue the hourly trend like this. We could even draw trend lines. We used the trend channel on the Wednesday video. Right, there's your support trend line. No gap fill reversal high or low, strike number 1. Okay, let's maybe neutralize the trend and hold up at these equal lows on the hourly chart. Strike number 2, close firmly underneath that 559.75 if you want to be precise with the actual number. So that's that. We could take a look at the intraday anchored VWAPs for more supporting evidence. Where are these clustered? I mean, this is the all-time high anchored view app, FYI, the one that's barreling down from the top. This is the low of the move. They're all clustered right at what I would consider the ideal or picture-perfect textbook lower high, right up against 565.50. So any counter trend rallies, it's not like, okay, let's like get all bullish all of a sudden and oh my God, the market's going to go back to new all-time highs and the structure's changing. No, this was okay, structure is changing. This is the structure change has failed, and now a lower high here makes total sense across all of the time frames we've analyzed so far. Makes sense that this potential lower high is the nail in the coffin to continue driving prices lower to maybe accomplish the monthly higher low pullback all the way down at 525. You can start to see how the pieces of the puzzle start to come together. So that's 565.50, that's 559.75 we've talked quite a bit about. What's the simplified pathing if we had to come in here with just like, bottom line, what is it going to be? Let's just simplify some of our anchored view apps out of the way. This is total bear flag consolidation, and I'm not even going to throw a fib on, but I guarantee you that's underneath the 38.2. Equal low is the first target. Beyond that, Brigade bolts that clearly accept underneath 552.15. You're just looking to walk down your levels. Lower edge, the weekly expected move is actually confluence with a previous level at 541.25. Let's go back to the daily chart just to understand the context of where that's coming from. It's this set of lows back here. You had a major V-shaped recovery. Remember, this is what capitulation is like. This was not capitulation. This is not emotional. This is like two-sided trade back and forth. You don't really have correlation, which means capitulation. This is like everything selling. There's no place to hide. V-shaped recovery seems reasonable, right? I would say if you want to try to make comparisons, not that I would call this a direct comparison, but this and this is probably more similar to this and this. And maybe that next leg lower is ultimately what brings in some sort of capitulation as and if we approach the monthly higher low zone. Once again, trying to put the pieces of the puzzle together. So getting familiar with what the next targets to the downside are. 541.25 coming from this major pivot low after the V-shaped recovery pullback. And then beyond that, there's a small unclosed gap here, 535.80s area. And then beyond that, we have this. This is where we start talking about the monthly zone, much closer to 529.50 if we want to use the breakout level, and the exact lows where we caught that higher low, 523.75. Am I saying we're going directly to here, as soon as the market opens up on Monday? Please don't misunderstand what I'm saying. I'm not saying that we should be thinking about this as a top priority. I'm thinking there's definitely a bearish edge out there. We've maintained our bearish stance. We see the logic behind why the buyers basically failed at the gap fill reversal. We saw the follow through to the downside. I think the picture is fairly straightforward. So just to talk about the simplified pathing one more time, this equal lows, great, Brigade bolts underneath, sayonara. I'd be looking at that 541.25. We'll update you on Wednesday if we need lower levels beyond that, and they're more so in play. If the market rallies here, maybe there's a thin structure retracement. You want to be quick draw McGraw. You want to try to scalp this from 559.75 into 565.50. Be my guest. But when and if we approach this level, I would be all eyes on, do we have a reversal back to the downside? Can we set that next daily lower high after something that looks like this? Where would I change my tone? Where would I be forced to have a little bit more of an open mind? If there's a recovery effort over this level, if we get some big miraculous rally that looks like this, and probably this, over 570, 569.75, that's where I'd start becoming a little bit more open-minded. Why is it that the market plunged back down into the original range? Why is it that the market failed back down underneath this, right here? If I just extend this off to the right, you failed here and you failed here. Let's put some dots. Why is it that the market would be finding price acceptance back above that level? I would be forced to change my tone if that's the case, because now we're starting to think about, okay, we have lows. This could be a daily higher low. There's undoubtedly been a shift in the hourly trend. You have highs, lower highs, right? You have lows here, you have lower lows. Even if you wanted to count from here to here, higher low, from here to here, undoubtedly a lower low, from here to here, undoubtedly a lower low. So you're definitely giving the market the opportunity to firm up a daily higher low. If that's the case, I just, based on the data points that we're going to walk through in today's video, would tend to think it is a lower probability outcome given what we're going to get into. So that's that. Those are the pathing ideas. Those are my thoughts on the S&P as we get more granular. Let's take a look at the market internals. If you're not familiar with this dashboard, take a look at the video tutorial in the top right-hand corner. We're getting tongue twisted here. What's going on? So my main argument on Wednesday, and we'll just rehash this very quickly, is that Monday's gap up was what caused the volume flows to look really aggressive in the upward direction, just because we were inherently over the Friday close from the previous week. But if you actually look at the cumulative build out of the tick, there was not much supporting evidence to suggest that these were new money buyers getting involved in the market. This looked much more like just a short squeeze. So, okay, we do not have any context that strong buyers are getting involved. Do we have the opposite? Do we have context that suggests strong sellers are getting involved? I don't know about you, but we have yes, we have a yes, we have a from 0 to negative yes, we have a from zero over or positive to negative yes, we have most of the day on Thursday yes, we have index score weak, we have index score very weak on the Friday session. If you look at the cumulative builds, tariff news across the exchange Friday, the stagflation news across the exchange, it's out there. The bears are there at the exchange level, confirming the breakdown, whereas on the flip side of the coin, we never really had confirming upside action here as the market was trying to break over that key level we talked about, as far back as last Saturday's update video. I do also want to show you that the pace of the breath, you can see it literally in the trajectory. You can imagine the velocity of the breath here, but we actually have a study for this, right? We can track that. We can plot this. If you take a look at the intraday breath of the market, it closed here at -6, give or take, but the absolute worst reads that we got were a little bit worse than that. -7.6 here towards midday as the market's really accelerating to the downside and nothing is finding acceptance inside or above the previous day's settlement. So bears are confirming at the exchange level. Let's take a look at the market profile. Confirmation here, Wednesday, value lower. Thursday, value overlapping to down. Friday, value closes dead on the lows of the session. Same thing with the point of control. We do have a little bit of a B-shaped profile taking place here, something that looks like this, which is usually indicative of long liquidation. So if we do start to see any sort of move back in the upward direction, I would primarily be focused on about half back, which is the purple/blue line on the screen here. If we start getting into these B period single prints, that would be over 56.70, give or take. If we start to get above that, I do think a thin structure retracement could be on the table. You can see there's not much volume commitment at these particular levels. Maybe shorts late to the party start to squeeze a little bit, but I don't think that this does anything to dramatically change the tone of the analysis we've conducted so far. Remember, we're saying that either consolidation down here in this value area is just bear flag consolidation, or if we do rally, a lower high rejection of the top of the balance range, the bottom of the do or die zone. I know we'll get back to the picture of that in just a second. That makes a lot of sense for the bears to remain in control. You take a little bit of the momentum short froth out of the market from here. You let stronger, more convicted shorts establish a short position here, and then maybe we see that stronger follow through, right? So that's my take on the B period single prints, A period single prints. If you're not familiar, by the way, with market profile, check out the video tutorial in the top right-hand corner. Very, very interesting stuff. Helps us understand the market in a third dimension, which of course is time. If we just look up, I do want to point out that this poor low from Wednesday has been repaired, but we do have a poor high from the Thursday session. So carry that forward. It's not something I would look for like, hey, we got to go back up there and break it on Monday. That's not really how I would use that. But if the market sort of does not find clean rejections underneath Wednesday's low, if we're not really staying underneath, 57.25 is really the level that we've been using in the futures. I'll continue to use that level, actually. 57.25 really represented more of the gap close. If we start to find a little bit more acceptance over that, then maybe this is in play, but just carry it forward in the narrative. Let's go back on over the picture just so I can show you that one more time. This is the value area consolidation I was just talking about. This is the single print retracement, which we already covered as like, if you want to try to long that as quick draw McGraw, be my guest, but please respect 565.50 as a potential lower high. And that is your S&P analysis. Let's reset this back to our charts here. Let's go to the NASDAQ. Let's take a look at the monthly. And one more time, just as a reminder, this does have a day to go until the close. We have Monday, March 31st. Still, as of right now, solid red-bodied bar, very minimal wicks on either side, hardly even there. Bears are in control. Big shooting star precedes it. We have a lower high and a lower low on the bar-to-bar count. Our retest zone on the monthly would be much closer to 450 out of the QQQ NASDAQ. And if we just take a look at what that drawdown would be, let's come in with our measuring stick. That's about a 13.9% drawdown from the all-time high, which is loosely related to that 14.5%, 15% max drawdown. That study was really done for the S&P 500 in particular. So we'll remove that. Let's quickly check in on the monthly Fibonacci's from the lows up to the highs. That's well above the Fib 38.2. The monthly trend, by the way, we probably should have started, but this is still intact. We have lows, higher lows, soft higher lows on the August 5th panic move, of course, but we're basically looking for previous resistance to act as newfound support. 450, same level we just described. Let's come in here with the monthly 20 SMA. Is that in, come on. It's pretty solid. Looks pretty solid there. Also meeting for technical confluence. And what is the bull flag was not so much in play here in terms of the measured move to the upside. Reason being is that your pullback, if we just bring out this real quick, let's do this, let's do this, let's do this. You overshot the 100% mark, but I would just remind you, on the monthly time frame chart, the S&P 500 did not pull back to the 61.8. It was much more respectful of the 38.2 with just a couple of wicks hitting the 50%, whereas the NASDAQ was a little bit deeper there. So not overly concerned with that from that point of view, with this not aligning as well. Let's take a look at the weekly. Let's drop it on down here, and let's see what we can see in the more short term. Same commentary ultimately as the S&P 500, where you have a solid red-bodied bar with just a little bit of an upper wick. When we checked in on Wednesday, it really wasn't that bad. It was still an inverted hammer. Friday, of course, brings in the pain almost at the equal low already. Still getting a rejection of the weekly 50 SMA, bearish engulfer. Everything about the structure and location here goes to the bears. If we think about this as a rejection, you have previous resistance, acting as support from the double top neckline, a perfect retest rejection in the upper wick of last week's bar. Once again, a very complementary analysis to what we've just done over in the S&P. Let's come in from a fib point of view from here to here, rejecting the 38.2 at the 61.8. If we break it, things get ugly. I would start thinking about 450 is a little closer. 450 is here, so maybe targeting not the full 100% retracement. We'll take it one step at a time. If it does ultimately continue to look weak down here, let's say that there is no sign of buyers stepping up at 450, then of course we'll just trade the chart in front of us, and if we get something that looks like that, that will be a reasonable outcome. If the market does respond off of this, as let's just theorize here, right? Maybe the weekly is trying to produce some sort of double bottom low. Touch one, touch two, we sort of open up here, wick it, and then come back into range. I wouldn't be bullish there on the weekly time frame chart. I would certainly need to see some sort of breach of last week's high to get back into this overhead supply before I start saying, hey, we're out of the woods from the weekly downtrend perspective. The weekly was just a little bit of a fluke. It was an overshoot. It doesn't really look like an overshoot as of right now. Let's come in here with the anchored view apps on the weekly perspective. Very complementary again to the S&P. A majority of the cluster is above, and we've closed underneath. This anchored view app comes from our pullback low here. This is the mole thesis, if you remember, MOHL, monthly high or low. Seems like we're going to have to bring that acronym back out again for the 525 S&P and 450 QQQ. But regardless, that's the anchor point, and that is tying in with what? 450, that magic area of potential support on the higher time frame if the pullback continues here, which in my view seems a little bit more likely than not. Just to be congruent, we will look at the volume profile. Oops, that's not what we wanted there. We wanted the volume profile. Here we go, and zooming out slightly to illustrate the high volume node and how we have closed underneath. No good, bearish. Buyers really wanted to see that act as support to potentially get back above the neckline, and that's just not what happened. Let's take a look at the daily and firstly evaluate the weekly expected move here for our NASDAQ. We'll adjust this on the screen such that we can sort of see this with a bit more clarity here. Let's get the all-time high on there. There we go. So this is the expected move. You already know the video tutorial was in the top right-hand corner. Upper edge is at 483.49. Lower edge is at 454.34. Lower high and lower low, just like the S&P 500. Not much to see there. The overall trend remains down where we have highs. Never really even got a soft lower high here. We can just throw it on the screen for the sake of having something, but this is just a clean lower high. Unlike the S&P 500, the NASDAQ never actually found price acceptance over the 200 or over this critical area that we've been using. We all know 492.50 was the zone we were watching. It was confluence with the upper edge of the weekly expected move last week, and that offered the lower high. So from a technical point of view, does this lower high make sense? I think the answer is 100% yes, both weekly and daily. There was no semblance of support here to hold up over the top end of this. You could consider this a multi-day balance range right here. The original range comes from these balance days back here. But for the most part, bulls would have wanted to see what? Let's put ourselves in the shoes of buyers here. Buyers want to see this. Continuing to chug along in the upward direction, use previous resistance as newfound support, use previous resistance as newfound support. Did not happen. They had the opportunity. They had a little bit of a break up here. They had the pullback. They had the decent close on Wednesday. Thursday, nail in the coffin, rejecting this upper bound of the balance range here, closing the gap all the way. No gap fill reversal on the Friday high of now last week, or 2 weeks ago, depending on how you want to count. And of course, the Friday session is just obliteration. We could call this almost an engulfment. You can see 3 days is all it took to take back, let's just count here, even starting back here, honestly, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days of consolidation where, honestly, I got to admit, out there in the sort of social media sphere, everybody's saying, hey, it's looking like a little bit of a bottom. Market's going to go rally to new all-time highs. This is a bull market. What are you talking about? Markets are going to crash. 3 days took back 13 days of balance where we were hanging in the limbo of, is it a balance range bottom, a structural low, or is it just a bear flag? I mean, if you've watched the last couple of weekend analysis videos, the midweek market updates, the pre-market preps, you know my stance. You know we were thinking about trend continuation to the downside. So point being is the engulfment of what's happened here, in my view, is a huge failure of the buyers, anybody who was arguing that we were trying to produce some structural low over the 13 days where the market sort of kept us on edge about whether or not that was or was not going to happen. So point being, rally rejections here, big time lower high again on the daily time frame chart. That's 480.25. Equal low breakdowns under 467, should bring us to the next target, 460. Beyond that lower edge, the weekly expected move is just above the structural element at 451.15 for the same reasons as what we said in the S&P about trusting or putting a lot of emphasis in the upper and lower bounds here. I would not do that, right? Look at Friday's session. It's almost the entire expected move, right? Because you have to remember expected move is plus or minus. So we're really forecasting that on either side, that doubles the expected move. There you go. One day was enough to hit one side of the move. So keeping that in mind, be open to volatility. The markets look bearish. Obviously, we also have, this is maybe a caveat where, we maintain this bearish stance because the evidence suggests that. But we cannot forget, and I said this even as we were at the highs of the move here, and I'll say it one more time because it's so important. You cannot just throw away the risk-reward principles when it comes to trading just because you're at a particular area or you think that the trend is doing a particular thing. Is it ever a good idea to be short dead on the lows of the move here after a 100% retracement like this? Like, my jaw would not hit the desk and I wouldn't be like, oh my God, I can't believe the market bounced here on Monday. If there's a little bit of a relief rally, that would not be surprising to me. The idea would just be to spot the next lower high in the trend count. If we do go through the equal low, then you would just be looking for the respectful lower high underneath this, so at least you can manage your risk. Again, the risk-reward principles need to remain top of mind regardless of how you feel about where we are in the trend count or what you think is going to happen next, right? So 467, 460, we talked about these downside levels. Enough on the daily. Let's drop it down here. I suppose just to be, did we do this on the weekly? I don't think we did. But point being is that it's still a rejection of the 38.2 there at the 200. Very complimentary to the S&P. I've said that too many times now. Let's come in from the low, though, up to the top. No hold at the top end of the balance range here, fib 38.2. The 61.8 is the midpoint of this range, so I would have been thinking, all right, if this is the balance, buyers would have wanted to step up here at the very least, and once again, that just simply did not take place. So do we have stronger buyers trying to exercise their, trying to flex the capital and say, nope, we're going to buy this on every new pullback, and we're going to suggest that this is a structural low? No. You would have seen this hold. You would have seen on Friday an open here that stayed above 480.25. You would have seen an end-of-day rally that maybe looked like this, Brigade Bolt over Thursday's high. Then you would have had structural low, structural higher low, structural building block for a higher low. It didn't happen. There is no response here, and at the exchange level, we're seeing the reinforcement of that idea. One more time, I would think that a rally rejection of 473.25 would be the first thought. That's where I would look for a first lower high on the hourly perspective. Equal low becomes the target, risk, reward to the downside. If we go above 473.25, I would be open-minded to the counter trend, bringing us to 480.25, in which case, just like the S&P, looking for a lower high there. Equal low becomes the target over time. If the market goes straight through 467 and we see a gap down, because it's also possible, we didn't really talk about it from the futures perspective on the ES. We'll get to the NQ in just a second, but into the before the close, right? Not just the maintenance close, but the full weekend close before futures open up on Sunday at 6. We did see some follow through to the downside in the after hours on the NQ and the ES. So it's very possible that a gap down on the Monday session could be within the realm of possibilities. If that's the case, then I would be interested in gap fill reversal, trading to the downside, right? Looking for the lower high, repair the structure, close the gap overhead, then see the follow through to the downside, 460 being that next target. All right, those are my thoughts on the NASDAQ intraday. Let's take a quick look at the anchored view apps intraday, just reinforcing the same thing as the S&P, do or die zone, 480.25. That's your major lower high to watch out for. Where do I have to change my tone? I'll change my tone slightly if we get here, and I will absolutely change my tone if we're back over the top of this previous balance. 485 is the number on that one. But for now, I don't think the bulls have the data in their favor. Let's quickly check in on the NASDAQ internals here. Rinse and repeat of the S&P, not new money buyers on Monday as sort of foretold by the cumulative tick. You can see big volume outflows, even worse than the S&P on the NASDAQ side of things. Let's just remove that study. What was the worst breath read that we had here? Negative 4.7, not quite as bad as the NYSE, but still fairly aggressive. Usually what we're looking for there is anything underneath negative 3, and on the upside it's positive 2. You always give a little bit more to the downside just because emotion drives stronger numbers, right? Clearly, a huge degree of correlation to the downside at the advanced decline line level. Big cumulative tick builds on the downside here Wednesday as well as Friday. One more time, does not look like new money buyers are stepping up. Clearly they're not. Prices obviously lower. But on any of these consolidation efforts, even Tuesday, early in the session on Thursday, nothing going on for the buyers there. Let's finish it up on the NASDAQ side, at least with a look at the market profile. Let's take a look over here. And I think what we're going to find is a rinse and repeat of the S&P, so we won't keep you too long on this one. We've repaired the poor low, thin structure overhead. Once again, it's the same idea. Consolidation bear flag, thin structure retracement for quick draw McGraw, looking for a lower high here, all set. If we find acceptance above and I have to change my tone, I will carry forward that on the Thursday session we do have that poor high. Let's jump back over to the platform. Let's finish up the broad market look with our final index here, the IWM, Russell 2000, and the small caps monthly time frame chart, clean drawing set. And let's zoom out here so we can see a little bit more time. There we go. So smalls on the monthly look pretty horrendous. I've been talking about the opportunity for that monthly higher low being much more top of mind in the small caps based on this, right? This is a balance range here. 50 SMA on the monthly needs to hold for support, the top of the range, if this is going to be constructive, right? Big if there. If you're a barrier, like, no, bring it on down, come back down into the range. I want to see the failure back down towards the lows at 160. Fine, you can maintain that bearish stance, but for the most part, coming from the highest high, remember this is an ever so subtle new all-time high. You can see that on the intraday. This is a pullback from the highest high, which means our first thought should be for a higher low at a structurally relevant place. Now, of course, we have issues with that because the weekly time frame chart has already suggested a firmer rollover much earlier than the other indices via this head and shoulders here, right? We know that we have left head, right shoulder, great, we're under the neckline. It's do or die. It's right here, it's right now out of small caps. If we cannot hold around this $200 mark flat, the monthly 50 SMA, I really think we might be in store for a little bit more pain than just that 14.5% pullback in the S&P 500. Why? Because small caps, as we know, are typically a bellwether gauge for more of like that parity to the economy, right? The S&P, not so much the economy. It's dominated by large tech, and of course, their balance sheets are very flush with cash, and no problem. But small caps, you're dealing with a little bit of a different beast here. So really interested in this 200 level, which I think is very obvious. If we come in here with this Fibonacci, let's get a click, thank you, Thinkorswim, to the high, it is right near the 50% retracement. I would say 61.8 is sort of the line in the sand there. That's 193.50, a little bit of wiggle room. I don't love that. I really don't. The structure is, of course, bearish. The location, bar-to-bar count is bearish. It doesn't really look like a compelling chart here for a strong reversal. It doesn't look like small caps are going to say things are fine and dandy. So although I want to be based on the way we count trend from the highest high looking for a higher low, although I want to have that mindset here, I'm just not seeing the response really from the buyers yet that would have me confident or enthusiastic about a potential turn from this drawdown that we've seen. What else can we throw on? We could put on the 20 SMA, although obviously we're going to be underneath that. So that's not really too much help here. And we could take a measurement, although this is not a relevant pullback metric in the small caps. That study set was for the S&P. So we're already down about 20%. I mean, it's a bear market again in small caps, very similar to what was going on over here, right? Let's drop it to a weekly time frame chart and see what else we can glean. Let's get rid of that weekly 20 in here. No need for that guy anymore. And what do we have? Bearish engulfer closed right at the weekly 200, well underneath the weekly 50. The downtrend persists. We already talked about the head and shoulders here. We're well underneath the neckline. Lower high, nothing really constructive to say about this. I would just think that a breach of this level sort of brings in a bit of a threat through some of this thin structure retracement, and unfortunately, that's straight to the bottom end of the monthly range that we were just talking about. So, like I was saying, it doesn't seem so compelling that we just want to change our tone just because we're pulling back from the highest high on the monthly. It's going to require a weekly trend change before that's really a reasonable outlook here for smalls. Let's take a look at making sure we just have enough data to capture these areas. The VWAPs may be interesting. Previous all-time high, one of the lows from the balance range back here where all this consolidation took place. So anybody who built a position in here is kind of like, all right, you got to hold it right here, right now. It's do or die, which I think makes sense given all the analysis that we've conducted so far. It's just the fact that we do not see signs of a reversal stepping in here on the weekly. Do we see anything from a fib? I'm not even going to bring out the fibs, right? You do it in your head, right? From here to here, are we over or under the fib 38.2? Obviously underneath, that's bear flag consolidation, no need. Let's come in with the volume profile. Always good to do that mental exercise. I think it keeps your eyes sharp. It keeps you thinking about what's going on in markets just organically instead of always having to rely on the studies. High volume node potentially underneath us. That's an interesting one to maybe keep top of mind, top end of the balance range in here. So it makes technical sense. It's just, is there a reversal? Once again, we're not seeing that evidence. There's really nothing here. Solid red body bar, bearish engulfer, lower high, bar to bar count. Just nothing happening for the bulls. Let's take it down to the daily then and see as we get granular. Is there anything encouraging from this point of view? Unfortunately, the answer is just another resounding no. Why do I say a resounding no? Because if the buyers were going to make something happen, we would have been talking about this, right? And what were we waiting? What were we holding out so patiently for? 209.25, no dice on the break up and over. So being back down underneath the right shoulder of the inverted head and shoulders, kiss that pattern goodbye. If you really want to stretch your luck here and say it's a double bottom, fine. Doesn't change the place where the neckline is, so that's no good. Does not look like a compelling close on Friday. Looks bearish to me. Looks like an opportunity for a lower high either underneath these flat lows or just at this structural element, which was the first dividing line between the upper and lower balance range, 204. We're very familiar with that level on smalls. I'm just not seeing anything bullish. Nothing bullish happening here. Could you get some sort of double bottom? Again, the answer is technically yes. There's nothing saying that this can't happen, but I don't think that the data, the supporting evidence, is saying that it's a high probability. Thinking in terms of probabilities, I would tend to say lower odds of that potential outcome happening here. And when and if it does happen, we'll just change our tone here. And that'll start acting as more of a bullish tailwind for our good friend, the S&P 500, when and if it happens in the first place. So what can we say about downside targets? We're really going to have to zoom out here a little bit and continue looking left. If we take out this big sweeping set of lows, 198, you're looking at this next major pivot low down here, 191.75. That's underneath the lower edge of the weekly expected move, which, by the way, is bearish, just like all the other indexes we've seen. We have a lower high as well as a lower low. That's 206.80 and 194.07. So 191.75 was that next one, and then 187.75 really starts to get, we got to look back more than a year. More than a year. We're looking at this, and that's like the final straw, because as we mentioned on the weekly, you break down underneath that, it's nothing but a thin structure retracement back down towards the bottom end of the range, closer to 160. So, I'm not saying we go to 160. I always want to make sure nobody misconstrues what I'm saying, but there is some structural threats as and if the Russell breakdown continues, which will just be a headwind for the S&P 500. Here it is on the hourly side of things. One more time, put yourself in the shoes of a buyer. Buyers wanted to see consolidation over these previous areas of resistance. A Brigade bolt over the inverted head and shoulders neckline. Great, we're breaking out. Didn't happen. Buyers wanted to see a gap fill reversal, a break back over Thursday's high on Friday. Didn't happen. Buyers wanted to see this hold up as support, 202.40. Maybe it's a look below and fail. It's an hourly inverted head and shoulders like this, and it didn't happen, right? You see where I'm going with this? The buyers are not stepping up at the locations where they should be if these reversal patterns were going to be more severe, and this lower high never actually took out the interesting zone that we were tracking in the first place. There was really no reason to change your tone to being overly bullish, maybe neutral when this was taking place, but as soon as Wednesday's breakdown away from this happened, nothing more than a daily lower high, right? Let's maybe throw on the intraday anchored view apps just for kicks here. 204 key level, rally, retest, rejection, 202.40 as we already described. 204 would be a nice one as well. I would fine, right? Anything here as well that's still underneath the neckline of what could now maybe be considered the double bottom, 207.25 upper edge of the weekly expected move, another lower high opportunity. I think the bears retain their control. Obviously, straight up downside, please be mindful of your risk reward location. We would ideally be fishing for outcomes that look like this, so we can say risk, reward, and looking for that follow through to the downside. No need for the fibs. Again, do the mental exercise. If we put one on from here to here, where are we? Clearly underneath the fib, 61.8, meaning the 100% retracement is more likely. Let's check in on the Russell internals, not the exchange Russell, but rather just the Russell index internals. We have strong volume outflows on the Friday session, which makes sense. We have decent cumulative builds to the bear side on 3 of the 5 days, flat on Monday for the gap up, not really indicative of new money buyers there. This, of course, is primarily due to the reciprocal tariff headlines, Europe sort of caving in a little bit already, but very short-lived, right? Clearly these tariff fears, and even on Wednesday, right, with the autos, just clearly pushing markets aggressively lower out of smalls, falling off of a cliff, bearish consolidation here on the Thursday session, Friday follow through, completely confirmed by the index level internals. Taking a look at the market profile for the Rusty Russell, what do we see over here? Same thing, same exact thing. So with that, we're just going to bump right back over to the platform and we will take a look at the S&P and we'll evaluate our sectors. We'll get into the supporting evidence. What do we see? Who was leading? Who was losing? And where was the weight? We have the XLP leading the pack. I don't know about you, but consumer staples, defensive. Absolutely defensive. Up 1.75% on the week, but the chart has some issues. We'll get to that in just a moment. Energy, also a leader up here, but only up 23 basis points. Aside from that, there's no hiding. Semiconductors brutalized with some of that China news as well. Remember, the U.S. blacklisted about 50 Chinese companies saying that no, NVIDIA, you will not export chips to these Chinese AI companies. We need to maintain our edge. So down 7.43% on that, and it's actually worse than what meets the eye. We'll talk about that in just a second. And I know I said I only have one trade idea in the introduction. If you stick with me here, there's a couple of sectors that we can dive into where you can probably formulate some ideas outside the scope of what we say for the end. Anyways, XLK, the next down the most, the next worst sector, there you go. So almost down about 5%. It's 4.96% as measured from Monday's open. Communications also taking a beating here, down roughly 3%. Financials still getting brutalized, down over 1%. Utilities, defensive anyways. Discretionary is another heavier risk on sector, down 1.36%. Does not look like a risk on rotation. It does not look like you want to be bottom fishing out here and saying, oh, look, you know, it's only the breakdown's only brought to us by some of the defensive lightweight sectors. Not the case. Not the case based on what we see here. Let's take a look at consumer staples. So as I was saying, yeah, it outperformed on the week, but first of all, it's D for defensive. And secondly, it didn't really do anything to get me thinking about a stronger recovery effort here. It still looks to me that there's a strong opportunity for a rejection lower high underneath this overhead supply. Seemed as though the market was unable, or at least I should say the consumer staples market was unable to close this gap overhead. And any sort of breakdowns back under 80, I think kiss it goodbye. And now you're dealing with left, head, right, and it gets worse, as in if we breach 78 and the gap closed there. That's what the bears want to see. The bulls want to see some sort of consolidation and prove me wrong by Brigade bolting over 81.40 at the end of the day, or the beginning of the morning, because technically the market's open at 9:30 a.m. What do we say? It's still a defensive sector. It's not the one that you want to see leading any sort of reversal out of the S&P 500. Energy, rejecting a little bit off the top end of the range. I'll be more impressed when this does something here or here. So let's just move along. If anything, this, a little bit inflationary. If you really want to dive into this, you could take a look at /RB for gasoline futures here, continuing to push in the upward direction. A little bit inflationary. You could take a look at, should we do it now? Yeah, let's go /HG for copper. If you want to talk about inflation and energy and what's going on there. Copper certainly moving in the upward direction. That is inflationary. You could take a look at, is it LB for lumber? Ooh, LB, yes, it is. LBR. Let's try the continuous contract. No quote on that from here. Let's try LB. Do we need to just throw an expiration on it? Let's see if we try the K contract here. Let's try it. Not really what we're looking for. Lumber futures are up. If you look at lumber prices, they are ultimately up. Is there some sort of lumber ETF that we can quickly look at? Lumber futures, no, I want a lumber ETF, please. Let's just try. I don't know what this is, so please don't hold this against me in the analysis. No. I guess a proxy for this is you would see an inverse move out of the what? Well, of course, the XHP. XHB, copper futures are up. Lumber futures, I know they're up. You can find the chart. I'll probably overlay it in the edit, actually, instead of making myself look like an idiot and not finding it. But XHB home builders moving lower. That's inflationary. It's harder for the cyclical side of the economy to take a grasp here with home builders moving lower like this. So that doesn't add up to being like, hey, we're all set on the inflation front. Energy's not really telling a nice story. The home builders aren't really telling a nice story. Copper futures, lumber futures, not really telling a nice story. It's not what you want to see, to be quite frank. And I think it adds directly into the title of today's video, the introductory remark of stagflation, right? Semiconductors. Why is this maybe worse than what meets the eye? Well, this is an equal low out of the actual ETF itself, and NVIDIA does have the opportunity for maybe a higher low, but we all know that this is overhead supply. This is a massive lower high. This is classic Wyckoff distribution here. Here it is, actually. Let's do this. You fail to make a higher high. You make a lower high in range and then a lower high under range. Sayonara. Stage 4 distribution. It's bearish. We've been bearish on semiconductors. You guys have been tuning into the channel. You know this. Why is it worse than what meets the eye? Let's quickly flip. Let's do it in the, let's just change this one. Let's go to our little semiconductor list here and let's take a look really quickly. These are daily time frame charts. New lows out of ON Semiconductor. NVIDIA, not quite a new low. We gave that one the benefit of the doubt. TSM, Taiwan Semiconductor, new lows. Intel, not quite new lows, but this is a long-forgotten dinosaur. Let's just move along. MU, big flush point, big danger zone underneath that level. So when I was saying just a moment ago, you could probably formulate some trade ideas here. Micron could be a short on a Brigade bolt underneath that set of flat lows, right? NXPI, big-time new low. If we take a look at ASML, right at the equal low, if not closing ever so slightly underneath. Applied Materials, new lows. If we take a look at AMD as a higher low, ding, 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 Kathy Woods and Lisa, maybe they're in cahoots here to prop this thing up. AMD is an outlier. Qualcomm, big shelf, big flush point here, 150, 150. That's a massive threat, in my opinion. Any Brigade bolts here, semiconductor sector, regardless of NVIDIA's high or low, it's going to continue to push to the downside. ADI, same thing, right? Let's take a look here at, not Taiwan, but rather Texas Instruments, right? It's aiming for that low. Let's not even get started on SMCI. Marvel, new lows. You see where I'm going with this, right? AVGO Broadcom, massive new lows. What about ARM? Massive new, not massive, but lower lows. Point being is that the semiconductor sector is not just NVIDIA, and spread widely across that sort of look, I don't necessarily think we will have a rosy feeling about what's going on there. XLK, technology sector, obviously similar commentary. It's the classic Wyckoff distribution, lower high underneath, equal lows. Looks concerning. Any further drawdown to here is like, okay, final stop, 203. You got to make it happen. Some sort of reversal. Otherwise, there's not much in terms of support under 203 until we hit 192. Heaviest weight risk on sector for the market does not look so hot right now. Let's take a look at communications. This to me is a classic head and shoulders in the making under the neckline. Sayonara, looking for the gap close and really a retest of this breakout point around 90.85. Being a medium weight risk on sector, I don't love the look of this. The lower high, and final comment before maybe we just speed it up a little bit through the remaining sectors is anybody surprised? Is anybody watching this video who's made it to this point? I know you check in on if you've made it to this point in the video, right? I know you watch these things a little bit more faithfully than the first 5-minute watchers who are just like, the market's going to new all-time highs, right? Nobody should be shocked. Over the last 2-3 weeks, ever since this drawdown has taken place, we've been saying the risk for lower highs is 100% real. We have not seen a capitulation bottom. We would need a structurally developed higher low to form before we change our tone, and the lower high is the first thing that we're looking for. So I don't think anybody should really be all that shocked about what's going on here. Industrials, lower high. If it was going to hold anything, it should have suggested that the right shoulder was still in play on Friday, and that was not the case. Close underneath, bearish. Materials, we already looked at the XHB, bearish. Let's take a look at the XLY. Lower high happening here. I would be open-minded to Tesla being a little bit of a dark horse here, and we'll talk about why when we get to that technical chart. But this, unfortunately, back inside of the balance range there, in my view, lower high in the range, equal low should be the target, and then another lower high, sayonara, if not just sayonara on the first go-around. So not really thrilled about what's happening here, rejection of the 200 SMA. Let's talk about healthcare for a second here. This is just another classic, very similar to industrials, perhaps, head and shoulders. A rejection there gets pretty ugly because we know that this is one of those defensive sectors, but it's still in the fourth heaviest weight place for the S&P 500. So if defensive heavyweight sectors are not performing well in some sort of risk-off rotation, that's where you get capitulation and everything sells off. So if this breaks the neckline and we're still seeing continued weakness for new lows out of the XLK, I think the writing's on the wall, and we probably accomplish our SPY 525 pullback for the monthly higher low. All right, so that's XLV. I do want to focus in and drill into the XLF sector a little bit here. Better bulls would have wanted to see a higher low over this 49.60 level coming from way back over here, establishing the neckline and the drawdown, the origin, the scene of the crime, as we call it. So better bulls would have seen a bull flag here and then this. Not the case. Why am I extra concerned about the XLF? It's not just the big banks, but take a look at something like your MasterCard. Look at this lower high. Look at the rejection of this level back here. You have to remember that MasterCard and Visa only recently got pulled into the XLF from the XLK. They used to be just considered technology companies. So this, more of a heavier weight, tech-oriented company in financials, that does not really spell like, hey, everything's great and we're just getting acceptance back inside of the overhead balance. You do the same thing with Visa, right? Taking a look at this, just a rejection of, you could call this some sort of like topping pattern, broadening formation, whatever you want to call it, doesn't matter. But after a breakdown, after clearly setting some sort of lower low underneath the 50 SMA, looks like a lower high opportunity to me up against 351.75. So you could use these as some trade ideas. There's probably trade ideas that you could formulate on MasterCard and Visa, but I will continue to keep you on the edge of your seat. No, I won't. XLV, UNH. UNH is the sole trade idea I was going to give you at the end of today's video. And we'll probably recap it at the end for anybody who uses the timestamps. But inverted inside hammers in a weakening sector that looks like it has a head and shoulders forming. Yeah, I'm interested in this pullback and this breakdown here, especially with the context of an overall breakdown in UNH in the first place. All right, so that's under 511.75 into 499. So the sectors and the trade ideas coming to form one cohesive experience today. There you have it. Utilities, nothing to talk about here. Real estate, not much to talk about here. And bonds catching a little bit of a bid on that Friday session, which is kind of an interesting take. It's like, well, I thought if stagflation was a fear, why are bonds getting a bid and, in theory, pushing rates to the downside? Well, this is a flight to safety, 100%, instead of, let's drive interest rates lower, just under the premise that we should alleviate some of the stress for the economy, right? So that's the TLT. Let's take a look before we get into some additional supporting evidence. Let's stay on the sectors and look at ratios. If you're not familiar with the ratios, check out the video tutorial in the top right-hand corner. Bearish lower high, hanging in there, but D for defensive, and hanging in there, but really walking on thin ice based on what we talked about. So far, I would say not really a risk-on indication. So let's look at the risk-off side of things. Bearish in an uptrend back towards the equal high. Bearish after a pullback higher low at the equal high. Does not look like a risk-on market, and I think the price action speaks for itself. That shouldn't be shocking. These are more specialized ratios. This is bearish, this is bearish, this is bearish, this is bearish. You really want me to keep going? This is bearish, right? We could take a look at some more risk-on versus risk-off. Let's go to the TLT ratio this time. This is bearish, moving back in the upward direction. There's clearly a preference to get out of equities and go into something more defensive like bonds. That classic 60-40 portfolio is back in play, baby. Let's take a look at gold, because this is another proxy for risk-on, risk-off, or risk appetite, you could even say. Gold massively outperforming the S&P equities into the end of the week. Just a huge flight to safety, risk off. Get me out of equities here. It does not look good. Get me into something a little bit more stable, something that's clearly been on a tear recently. Gold, not really boding well for a risk appetite resurgence in our equity market down here. So all of the supporting evidence, I don't know how you could look at me with a straight face and say, no, I think that the buyers are going to come out of nowhere and just like all of a sudden a new all-time high is going to appear. I don't see it. And we haven't seen it for 2, 3, 4 weeks now. Go back through the videos. Dixie, lower high in the range. I think that this is less about, I would say it's less about the earnings and how this influences the earnings for the S&P and more about that currency conversation we've been having. Let's go 6J for the yen, getting a little bit of an uptick into the end of the week there. Remember, yen strengthening should bring money out of equities. You could say the same thing about if we go to the 6E for the euro. We've been seeing some consolidation here after the big push in the upward direction, just money flowing out of U.S. economy. Think trade war. Also think about Japanese inflation and Bank of Japan intervention, which should, in theory, collapse the carry trade. That's still an idea, but until let's go back to the 6J for a second here. Until this breaks out to some sort of like major higher high or an equal high back up here, I would not be carry trade collapsing. Oh my God, I'm a bear because of that. It's a mild data point at this point. But if it really accelerates, that's where it'll take more of a grasp on the market. And you'll know it. You'll know it when the market freaks out, just like it did back here on August 5th when we gapped down, whatever it was, 100 handles in the S&P 500. Let's move along to the interest rates, see what's going on here. Rates coming down, obviously inverse to the TLT. Not really a shocker there. I think the Fed's caught between a rock and a hard place. So if we just go back to the inverted ZT, and this is how it always goes, right? Fed and Jerome Powell was actually very good about saying, nope, I do not want to declare a soft landing yet. I don't know if we've even landed yet, XYZ. I think he's done good to protect his own reputation and not be overly boastful of like, hey, look at us. This is like perfect. We did it. Awesome job, right? So this moving lower, of course, insinuates, there's the word I'm looking for, that the Fed tracker tool is probably suggesting more rate cuts, probably something like back to 3 in 2025. So let's take a look over at the platform here. Let's give that a little cancel. We don't need that, but we do want, where's the Fed watch tool? Here it is. Let's take a look. If we just divide, there is the calendar year end, 1, 2, and 3, back to 3 rate cuts in 2025, and aggressively another cut here in 2026. So the SEP continued to reinforce 2 rate cuts in 2025, and the market's saying, no way, Jose, there's going to be issues here. This is the market getting ahead of pain, perhaps, in the labor market, which we didn't really see on the Thursday release of the jobs data. So that's your Fed watch tool. Let's start getting a little bit more fundamental with the actual news that came out. I would say one of the better data points on Wednesday morning before the tariff news was just that the durable goods orders, they looked okay. They were better than the expectation. So still getting some consumer spend. Is it pull forward from the tariffs, though? Could that be what's going on there? That's one possibility, which I think actually leans more bearish, of course, just that participants are fearful of inflation making a big resurgence. Jobless claims well within the bounds of reasonable expectations there. The expectation was 225. And also, just a reminder, you got to be over 250. Over 250 is where we sound the alarm, and it's like, oh my God, something bad's going to happen. And usually it's too late anyways. At that point, you're already seeing unemployment is a response. It is a result of the recession, right? It's not so much a leading indicator of the recession in the first place. So let's be clear about that. What else is happening here? PCE is the next big one to talk about after the tariffs on autos from the Wednesday morning announcement. But PCE on Friday morning, really kind of concerning here, hotter than the market's expectations of a 0.3 coming in at a 0.4, rounding from, I think it was like a 3.7 rounded up to 4%, not 4%, but 0.4. Let's slow down here a little bit. That was one of the strikes, but the next big strike was that the consumer sentiment on the revision actually came in worse than the initial, the preliminary. And that usually doesn't happen. Usually the preliminary is like way out of control and then the revision comes in a little bit. It was the inverse this time around, which I think speaks to that soft data that Jerome Powell was sort of not so accommodative of in his press conference from the FOMC just weeks ago. If we take a look at the actual breakdown of the PCE, what I want to point out is, where is it? So durable goods here at a 0.3. That's the Feb, and of course the durable goods orders we just got this morning was, or the other morning was for March. So not really a concern yet there. We'll see if the next report basically reflects an increase out of that and whether or not that's more closely tied to tariffs and pulling demand forward. But beyond that, let's scroll down. Where is it? Housing and utilities, this one. That's what we care about. Really, to get to the Fed's target of, if you want to start talking about 2% inflation PCE-wise on the year over year, to accomplish that annualized, you really have to have your housing and utilities not have a string of data that looks like this. 0.4s are something you can't afford. You have to remember that housing and utilities account for roughly, if you use the CPI as a proxy, they're a little bit more public about what their weighting mechanisms are. About, right? Don't hold me to the exact percentage point, but roughly 50% of inflation comes from housing and owner's equivalent rent, basically, in the CPI print and the way they parse that out. But 0.4 annualized does not give you 2% inflation. That is obviously an uptick hotter than what the market was really expecting, and one of the big reasons why I don't think we're in a place right now, especially with copper futures rising, lumber futures rising, housing prices don't seem like they can come down, and you're sort of in this catch-22. And we talked about this a little bit in the live stream on the Friday morning session. You bring up, I forget exactly who it was, and that's going to kill me a little bit inside. I'm going to maybe have to go back and find that. But the conversation point just being that, won't higher rates for longer be combative to inflation, but also not allow housing prices to come down, which keeps inflation high? Yes. The answer is yes. And ultimately, right, the Fed's not going to come out and say this, but the result is that a recession forces things lower. You go through this nasty crash, reset of prices, and that's like the business cycle, right? So again, the Fed's not going to say that, but you can start to see the destination. It's not a light at the end of the tunnel. It's a black hole at the end of the tunnel that this perhaps alludes to. Now, when you look at the fundamentals, it's always doom and gloom. Would I still be open-minded to the S&P 500 technical higher low on the monthly time frame at 525? Absolutely. Absolutely. Remember that the S&P 500 is not directly connected to, in some senses, let's not get down the rabbit hole, but the market's not the economy's not the market, right? You've heard that classic saying a number of times. Let's move into the next thing to just point out is just the annualized reads here. So PCE year over year, 2.5 on the non-core and 2.8 an uptick from prior on the core. Not good, right? That is not moving in the Fed's favored direction. And then the next thing we wanted to point out was the revisions to consumer sentiment and inflation expectations. I've got two of them for you here. Here is consumer sentiment absolutely falling off of a cliff towards these local lows. The 2022 low was back over here. So think about that. The markets, I mean, obviously the market's progressed quite a bit away from the 2022 low, but consumer sentiment is in a similar spot. Not really looking all that good for a short-term bottom or at least some sort of, I think it helps us with the capitulation style. Like, you know, your uncle calls up the broker and says, you know what, screw it. The economy feels horrible. Sell it all, right? When you get that moment and everybody's selling everything, that's the bottom, right? We've talked about this in the past. Here are inflation expectations and just off the charts, literally off the charts. Markets very concerned about stagflation, which again was in the title of today's video and in the introduction as well. Earnings calendar over here. Nothing to pay attention to. We're mostly out of earnings season. I would say that Restoration Hardware is always just an interesting one as a bellwether for a little bit more of that upper echelon of spend for furnishing anything, really, offices, apartments, houses, whatever. So we'll watch out for RH earnings and whether or not they're citing any slowdown in consumer spend. Conagra, a little bit more on that consumer staple side if you're interested, and that's about it. I do want to bring up briefly that CoreWeave's IPO disappoints in the opening hours. However, if we actually take a look at the chart of CoreWeave here, let's go CRWV, I think is the ticker. Yeah, there it is. You got to give some credit where credit is due. On a day where the broad market was down big time, CoreWeave's IPO, I don't know how you can write a headline like that and still have a green print out of the actual IPO price. So not bad. A lot of IPOs flop a lot harder than that. You can go back and revisit what happened with maybe Robinhood, Reddit, Lemonade was one of those. Roblox was one of those. You can go back and take a look at those. But regardless, CoreWeave has some issues relative to their own business model. I don't think it's a bellwether for the AI appetite out there. Reason being, and you could read some of these articles. I was doing a little bit of reading myself. CoreWeave is just way over their heads in debt, funding the operation to set up and run these data centers, expecting that forward demand will be there over time. And that's a big question mark, right? Obviously making a pretty big bet that it will be there, but that's what the market doesn't so much like about the business model so far, in case you're interested. Let's get back on track for the remainder of our video. We've already looked at the bonds relative to the S&P, bonds relative to themselves, kind of flat, no big updates over here. The long end of the curve still trying to force Jerome Powell's hand, moving into credit spreads, popping back in the upward direction here and here. That is risk off. That's not helping the case for bulls. And bulls did have a little bit of something. It was like, okay, these are coming in a little bit harder than I would have thought. No dice. Bulls let that one slip right through their fingers. Let's take a look at junk bonds in isolation. This called the rollover basically, and we talked about it a little bit on Wednesday, just this idea of a lower low versus sort of the higher low that was happening there. We talked about this not being as extreme and the equal high more so. Regardless, point being is that junk bonds not really suggesting a strong appetite for risk either right now. And even if they do outperform subtly in the short term, that is always you would see equities as being more risky than junk bonds to some degree. And if you just look back at the dot-com bubble bursting, you can go back and find these studies, but junk bonds did slightly outperform. Even though they're both moving lower, they moved less lower, if that makes any sense, right? Bitcoin. What's going on? Proxy for risk on, risk off. This is still not a flight to safety asset. I don't know why people say that. It's not a hedge to inflation. It's none of that. it is a risk asset. So the fact that it's still underneath this overhead supply, sayonara, not looking good. Sailor shift ratio, still bearish as well. Let's move into total breadth, not helping the case for the market making a turnaround, still underneath the 50% mark in the moving average trackers, as well as new highs versus lows, remaining under the zero line. If we take a look at the RSP, one of the things we said on Wednesday was, hey, if it's going to make a stand, it has to stay over 174. No dice into the Friday session. You'll see the same thing on the equal weight NASDAQ and its level here, 89.20. If we take a look at volatility, little uptick happening here. Don't freak out. Oh, this is going to be a big lower high on volatility. Just you wait. If the market makes a lower low underneath this, I'm expecting a higher high out of volatility. You better believe that, right? So an equal low, of course you're going to get a lower high, right? That's just like, okay, we've been here, we've done that. Show me something new. That's where we freak out. So a gap down on Monday could be what does that. A gap down on Monday to here, an equal low, and then possibly a gap and go. I wouldn't be shocked if volatility starts creeping up to this local high. If we take a look at some of the, let's go deeper than just the VIX, right? We've been a big proponent of this recently. VVIX moving higher back over this shelf. That's one small warning sign. It's still a lower high, and you could say, oh no, Matt, volatility is still a non-issue. All right, let's keep peeling back the layers of the onion. Big time backwardation once again after flipping into contango. It's not often that you go from backwardation back to contango back to backwardation. That's much more indicative of a market that is not going to hold it together, right? If you take a look at the one-day VIX, this has been one of my favorites recently, is it never floored itself back down to 745, which is always what's required based on its limited history. I want to be clear about that too. Very limited history, but typically, if you're going to spot a bottom in the S&P, you need it to get back down towards that 745. We just didn't have that. So volatility is back and raging. One of the reasons why I would not be overly trusting of the weekly expected move. And I also want to bring up the skew in today's episode because we oftentimes focus on the skew and like, oh, wow, like crazy new record highs of the skew. The skew is a bottom finder when everybody throws in the towel and no one else is betting on a black swan event. Let's be very clear about that, right? The reason why we have this programmatically configured to throw a ping when there's a sub 113 print is because when you get there, that's typically when the market's like, okay, fear is out of the market, nobody's scared of anything anymore, the worst is behind us, and now we start to build a bottom. Right? So watching that very closely on the skew here from the weekly perspective as we come in off of these highs. Let's not forget about it as it's coming into the lows. We want to watch 113, right? And that's your skew, a little bit of a hidden gem towards the end of the analysis there. Let's get into the core list of companies. Let's wrap this thing up. Video is coming out a little earlier on a Saturday session. Hopefully you guys have a great weekend, enjoying some hopefully nice weather wherever you're at. NVIDIA is up first on the chopping block. We already touched on it with the semiconductors. If it was going to be bullish, it needed to stay inside of this range and potentially threaten the break to the upside for a weekly lower high up against 129, but it didn't even do that on Wednesday. And this is sort of a funky part as well, where we can have a little bit of a conversation here. Wednesday is auto tariffs, right? Let's think about that. Auto tariffs, semiconductors. And primarily, NVIDIA semiconductors at this point are like all about the AI trade. Yeah, there are some semiconductors in the chips and their computer systems in cars. I get it. But let's think about this through the lens of AI. You're telling me that auto tariffs are a big reason for NVIDIA to break down? I can't remember if this, it must have been. It must also have been the China news and the sanctioning of those 50 companies on Wednesday, because if it was just tariffs, you should not be looking at semiconductors or just generally the tech sector as a whole. Tariffs on autos should not break that down so aggressively. So at this point, what does that sort of bring into the picture or into the conversation is just more like, okay, you're looking for any sort of cautionary headline to sell the market. It's less about the actual fundamentals of NVIDIA, and it's more like, oh, this headline sparks some fear, sell it all, get rid of it. And that's hallmark of what? Volatility. So I don't think we're anywhere from that point of view. Anyhow, getting back to the technicals, so long as price is underneath this balance range overhead, it's sayonara, continuing to look for downside. Really, really stubborn move on Friday. I wanted to see that cleaner lower high here and like some actual follow through. No dice. But for now, it's just any rallies that look like this. Fine. Maybe there's a Stevie Wonder, a thin structure retracement over 110.85, something that does this. 114, count me in, coach. I'm looking for the lower high. If we have price action that sort of confirms that there's any semblance of sellers stepping up, I want the equal low, and I possibly want even further down towards 104.75 over the span of time. That could be a couple of day trades. It could be, I hope not for the sake of the market, one day, but you get my point. If it's going to be bullish, I wouldn't even consider this a look below and fail anymore because we've basically hit the target of the measured move range double. So if it is going to do this, it's maybe a little bit more structural, and I would probably participate not here just over 114, but rather over this at 115.25. That's the take on NVIDIA. Moving along to Softy. Reminder on the daily chart that there's this nasty overhead supply here. This is nothing more than a lower high underneath. Go back to the Wyckoff distribution. It gets ugly. It gets ugly. So nobody wants to participate in Microsoft. This range not holding, right? You're trying to build some stair steps in the upward direction, clearly failing, bearish engulfer to close out the week. Equal lows. If it is going to turn into a double bottom, like everything else, let it be a double bottom. We'll change our tone here. For now, our first priority is seeking lower highs and continuation to the downside via Brigade bolts underneath the local low at 376.25. Next downside target is the weekly cliff at 365.75. Kind of ironic considering one of their product suites is the Microsoft 365 suite. But there you go. Take a look at that, right? Take a look at that. Boom. Underneath there is nothing but thin structure, right? So 365.75, interested in whether or not that does break down. Let's move along to Apple. Let's go back to daily charts here. And let's see what's going on. I don't think there's really anything compelling to say about Apple on the long side. This is a lower high that we've been watching for very patiently, and it's just starting to break to the downside. I want the thin structure retracement through here. If we take a look at the hourly, this is that end of day OPEX sort of funky business. So under 219, just looking for that retracement to 214.15. If we do see some upside, I'm looking for rejections up against the double top neckline. Right there it is at 220.50. Not in love with Apple longs really at all. If we do pull back to this level, sure, you could get a counter trend lower high, but do I think it's a good long opportunity there? Not really. Not really. Let's move along to Amazon, Nancy. This is the one that had the best shot at potentially proving the market wrong and saying no, Brigade bolt over the range. Friday just puts a nail in the coffin there. I'm really a little sour about Amazon. I was holding out for the retest lower high here, $200.25, when in reality it was literally to the tick a perfect gap fill reversal up against the Thursday low. So a little sour here. Personally, just making mental note not to revenge trade this early on in the week. Yes, it looks bearish on a look above and fail. Yes, this range, or you could even just call this head and shoulders, whatever, it has broken down. It's aggressive, but do we want to be new money shorts smack on the lows of the range? Again, sort of like talking to myself here. Not really. I think the next responsible trade is a lower high at the midpoint, maybe looking for that, or let this unfold. Don't operate in the midpoint of a range because you never diddle in the middle, and then wait for a Brigade bolt lower high underneath 192.25 to get into 187.65. All right, so that is sort of how I would watch Amazon as we walk forward. If it's going to be bullish, I don't even know that I would want the thin structure retracement here, because if buyers were going to make something happen, it should have been right there. I'd be very skeptical of buyers inside of this balance range here. So therefore, show me this and the break of 206 will change our tone. I don't see a compelling bullish argument out of Nancy as of right now. Google. Just ugly, hideous, gross price action to the downside. Not gross, clean, bearish price action, but definitely bearish, right? Clearly rejecting the inverted head and shoulders neckline on the retest there on Wednesday, Thursday getting into the range, Friday going through the range. I honestly was thinking that a counter trend could have developed before the follow through. It just didn't happen. The market was just so, the tempo of the market was a little sluggish. So maybe I shouldn't use the word tempo, but the grind to the downside did not offer much of a downside entry, responsible risk reward entry, unless you were operating prior to the sentiment data at 10. Anyway, let's not hem and haw about that. The technical structure now just allows for a big time lower high. I'd watch 160, 150 if it does go for a counter trend. Otherwise, straight up continuation under 156.65, close the gap, and the next targets down below is the local low, or I shouldn't even say local at this point, but the pivot low, the swing low at 147.75. Beyond that, there is a gap to close from previous, not even an earnings cycle. I don't know what the news was. You're stretching my memory to think back all the way over here. Probably something AI related, but 146 closes down at 143.25. Moving along to the metaverse, Zuckerberg and his Fantasyland is suggesting the weekly head and shoulders, right? So under this neckline gets pretty dangerous. Break of the daily 200. We're looking for these lower levels to start coming into play. Just be mindful that this retest of the breakout is probably, I don't want to say the deepest it can go, but it would be one of the stretch targets into the upcoming week, 537.25 on the downside. Here it is on the hourly. Just like Amazon, be mindful that you do have a 100% retracement towards these lows. Think about your location when it comes to risk reward. Ideally, consolidation, Brigade bolts under 577, rock and roll. Lower highs here, also keep in play even a shorter term head and shoulders, something along these lines, right? So that would be 607.25 offering the rejection on that. Straight up continuation, you can go with it, but one more time, just please be responsible with your location. If you're trying to short Meta dead on the lows, you have to be someone who is respectful of your stop loss and willing to admit that you're wrong such that you can preserve your capital, right? The name of the game to stay in the game is to, when you're wrong, admit it as fast as possible. All right, Tesla. This is not a psychology reboot. What do we have here? Tesla double top. I love this. I really want some more bearish headlines on Tesla because what I'm looking for is Tesla's already down off of its highs 50%, right? From peak to trough down here is about 50%. If it's going to build out a structural low, I want to be looking for the higher low long opportunity here on the retest of the double bottom neckline at 250.50. Now, you could say, but doesn't that stand at odds with the general thesis of the S&P? It does. It absolutely does. And I think Tesla can be a dark horse. I truly do. It sort of falls always into its own category. It has a mind of its own. It doesn't always follow the broad market, but I'd just be watching this 250.50. All right, first test, best test. If it offers the trade, great. I would be very interested in trying some longs down here. If it fails, then like I just said, we'll be very quick to admit we're wrong. We'll preserve, and then we'll probably start flipping bias. JP Morgan, JPM. Just like the XLF, some concerns here. Let's go to the daily to actually understand this one a bit better. Best higher low would have been consolidation over 248. No dice on that. Clearly underneath, meaning a lower high below, starts to suggest short-term downtrend and follow through to the downside. I think if the broad market's going to, I'm careful with my words here, quote, collapse and crash, you probably want to see some weakness creep into the financials. This is a pretty strong recovery relative to what was happening in the S&P index itself. Financials need to be the straw that breaks the camel's back to the equal low. You're probably dealing with an S&P that's substantially lower at that point. So JPM could play a role in that, and that's so long as price remains underneath 248. Next up, last but not least, and then I'll rehash that trade idea for you on UNH. We have Netflix, lower high at the right shoulder. Also underneath the neckline as of Friday's close. So I think lower highs below 950, bring it on. I've honestly been a little skeptical of this long. You could hear it in my voice in some of the analysis, right? I was like, I really want to see this underneath the 250, goodness. 950 neckline. We're finally there. I think bear flag consolidation inside the range, this being the range, and underneath the neckline sets up the next move for back down to the lows. So 950.25, 924 will be the top levels in under watch there. Let's go back to UNH just for a brief moment so we can include it in the timestamps at the end of the video. We covered it through the sector watch, but here it is one more time. Bearish inverted hammers inside bar on the Friday session. Equal lows, 50 SMA. If it breaks down, really looking for this retest as a day trade. And then beyond that, we'll see if it goes further. I would start thinking about this, probably acting as a target. Let's go for 78 for the sake of round numbers. You guys know the deal up here in the office. That'd be the next stretch target. Firstly, interested in a possible day trade if the broad market remains weak early on in the week to 499. And that's all I've got for you. All I've got, as if an hour and whatever many minutes of analysis was, that's it. If you enjoyed the video, as always, let me know down below in the comments section or via a simple thumbs up. It goes a long way to help support the channel. Subscribe, turn the bell notifications on, do all that stuff that YouTubers are supposed to say. Remember that we are live every morning for the pre-market prep at 8 o'clock Eastern time. We'll give you a game plan for the session and hopefully set you up for a day filled with success. With that said, enjoy your weekend. Have a green trading week upcoming, and I will see you in the next one.